What if I told you the next tech billionaire isn't building social media apps or launching rockets, but training AI to predict your behavior, write your code, and even run your business? Welcome to the AI Gold Rush, where billionaires, venture capitalists, and ordinary dreamers are diving headfirst into AI startups, hoping to strike it rich. But why now? And why is everyone convinced this time it's not a bubble, it's a breakthrough? Let's uncover the reasons behind this investment frenzy. The new gold rush, but digital. In the mid-1800s, thousands dropped everything and raced to California chasing a dream made of gold. Today, we're in a similar race, only now the stakes are algorithms, not gold nuggets. Artificial intelligence has become the 21st century gold mine, and everyone wants a piece. From AI-generated artwork to autonomous decision-making systems, the applications are endless and the scalability is mind-blowing. Whether it's transforming transportation, reinventing education, or streamlining banking, AI is already embedded into our daily lives. And it's growing faster than most people can comprehend. And the capital, it's pouring in like never before. According to PitchBook, over $80 billion was pumped into AI startups in 2024. That's more than double the investment from just 2 years prior. The allure isn't just the tech itself. It's the promise of shaping entire industries, setting global standards, and creating monopolies and new frontiers. Big money, big players, bigger bets Microsoft didn't just invest in OpenAI, it integrated its models into Windows, Office, Azure, and even Bing, signaling that AI isn't just a side project, it's the future of their ecosystem. Meanwhile, Google, feeling the heat, accelerated its Gemini initiative and invested heavily in Anthropic, an OpenAI rival. Meta, Apple, and Amazon are also funneling billions into AI research, acquisitions, and infrastructure like never before, racing to stay relevant in an AI-first future. And it's not just the tech juggernauts. Venture capitalists are deploying capital at breakneck speed. Sequoia Capital is backing next-gen robotics. Andreessen Horowitz is betting on AI agents, autonomous dev tools, and biotech AI fusion. Funds from Qatar, Singapore, and Saudi Arabia are chasing AI unicorns in global markets. Private equity firms and hedge funds are also jumping in, hoping to cash out early before traditional IPO timelines. This frenzy signals something deeper. AI is not just a technological wave, it's an economic reset. The hype is real, but so are the risks. Here's the uncomfortable truth. The hype is very real, but so are the blind spots. Just like the crypto boom, everyone's rushing in, and many are doing it with minimal due diligence. Countless startups are launching with little more than an API connection to OpenAI and a slick UI. Others are chasing AI for X models with vague differentiation, hoping to get acquired quickly. We've seen this story before. The dot-com crash of 2000 wiped out thousands of startups with no revenue, no product market fit, and no real user base. The AI industry could be heading for a similar reckoning, especially for copycat ventures and low-utility products. Add in regulatory uncertainty, ethical concerns, and the risk of model hallucinations, and it becomes clear that this isn't just a gold rush, it's also a minefield. In other words, while the sky's the limit, not every rocket is going to launch. What makes AI startups so valuable? What's behind the massive valuations of AI startups? It boils down to 3 powerful dynamics. 1. Scalability. AI doesn't operate like a service that grows linearly. Once trained, an AI model can perform billions of tasks with almost zero extra cost. This means limitless growth without proportional overhead. 2. Defensibility. Companies with access to exclusive data sets, strong engineering teams, or novel architectures gain massive advantages. As their models improve, they attract more users and data, forming a feedback loop that's incredibly hard to disrupt. 3. Exponential impact. Unlike niche SaaS tools, AI solutions can disrupt entire value chains. A model built for real estate analysis might end up reshaping urban planning, property valuation, and even city development strategies. Investors are betting on AI not because it solves one problem, but because it redefines the way we solve all problems. The AI startup boom. Real companies, real innovation. While there's hype, there's also real innovation, and serious money is following the pioneers. Runway ML is revolutionizing video editing, allowing creators to generate cinematic scenes with simple prompts. Think of it as Final Cut Pro, powered by your imagination. Character.ai has built chatbots with distinct personalities. People spend hours chatting, forming emotional bonds, and even using them for therapy and companionship. Inflection AI, led by LinkedIn co-founder Reid Hoffman, is blending empathy and intelligence, pushing the boundaries of emotionally aware machines. Synthesia is transforming corporate training, marketing, and content creation with ultra-realistic AI avatars, saving companies millions in production costs. These aren't just startups. They're visionary platforms that are reshaping human interaction, creativity, and enterprise. They're carving out new categories that didn't exist 5 years ago, and their value lies not just in what they do, but in the industries they're creating. But who will win? With hundreds of companies entering the space, who will actually make it? It's not just about cool demos or viral moments, it's about 3 enduring traits. Execution. Can the startup deliver fast, iterate quickly, and adapt to shifting demands without losing steam or burning through their runway? Access. Do they have the compute power, think thousands of GPUs, access to specialized data and relationships to recruit the best AI talent? Ethics. With governments and watchdogs closing in, companies that flout transparency or misuse data could get regulated out of existence. The market won't tolerate vaporware for long. Investors want startups that are not only technically sound, but ethically grounded, efficiently managed, and ready to scale sustainably in both B2B and B2C markets. Should you get involved? So now we come to you. Should you jump into this gold rush as an investor, builder, or early adopter? There are 3 practical ways to do it. 1. Direct investment through platforms like AngelList or private syndicates. But beware, seed-stage AI investing is high risk, high reward, and often illiquid for years. 2. Indirect exposure. By investing in public companies leading AI infrastructure or integration. NVIDIA, for example, controls a significant chunk of the global AI GPU market. These bets offer less risk but lower upside than early-stage deals. 3. Build instead of buy. If you're a developer, entrepreneur, or domain expert, your best move might be to build a vertical AI product targeting a niche you understand deeply. AI is still early, and there's room for hungry innovators. The bottom line, don't follow the herd. Understand the fundamentals and make strategic moves based on knowledge, not noise. This is the AI gold rush, and it's still early days. There will be massive winners, tragic flops, and game-changing surprises. But what's certain is that AI is not a trend. It's a tectonic shift. It's rewriting how we work, learn, create, and relate. Whether you're an investor looking for asymmetric returns, a creator exploring new mediums, or a founder building for tomorrow, this is your time. Just like the internet in 1995 or mobile apps in 2008, AI in 2025 is your chance to get in before the world fully wakes up. The tools are available. The capital is flowing. The question is, will you watch the future happen or help shape it?